an A1. It's the highest quality mining services business in Australia, if not the world. But its prospects, which we can't codify in a score, its prospects look lousy because the iron ore price could go back to $10 a tonne. Now, how do we forecast a $10 a tonne iron ore price? How do we put that into Skaffold? It could be 20, it could be 30, it could be 40, we don't know, but we know it's going to be lower, not higher. So one thing that we can't codify, that we can't put into an algorithm that's an important part of your qualitative part of your assessment is the prospects for the business. You've got to think about its prospects. There is no tool that can just give you a red button or a green button to say the prospects are good or the prospects are bad. You've got to think about that. And that's why I said to you, Skaffold is absolutely the most brilliant tool I've ever seen for telling you where to start doing your analysis. Here are the A1 universe. There's 3 stocks there, Flight Centre, Macmillan Shakespeare and Ansell. There's 3 companies to go and research, but you have to research the prospects. You've got to work that out. There's no escaping that. It's still an A1 business. One of the things that you should never be concerned about is the current environment, because you'll never be able to forecast when the sentiment changes. So we don't concern ourselves. We know what the current environment is. I'll tell you, it's 3 things. 3 things. Interest rates are very, very low. When interest rates are as low as they are today, everyone's assessment of risk is corrupted. People are buying property trusts on 4% yields at 40% premiums to the net tangible assets of the property. In Melbourne, I'm very good friends with one of the big construction company owners in Australia, in fact the biggest privately owned construction company in Australia, and I was talking to him about what's going on. He said that apartments in inner city Melbourne at the moment, and I'll answer this question. There's a lot of information that I need to give you to help you understand why I think what you said is perhaps a flawed way of thinking of the market. Inner city apartments in Melbourne are currently selling for $12,000 a metre, right? Now, he has a commercial building that is tenanted to Westpac for 30 years. So it's an A1 client for 30 years. He can't get more than $6,000 metre valuation. Now, if you buy an apartment for $12,000 a metre and you rent it out, have you got an A1 tenant in there? Are you sure based on the supply increase that you're going to have a tenant? No. Why should that one sell at $12,000 a metre? The only reason it's selling for $12,000 a metre is because interest rates are low. People think property prices are going to go up, so they're buying the property now in anticipation of someone paying more for it later. There's that is going on in the stock market and in the property market, but that is not investing, that is speculating. You are speculating that someone else will pay more for it later, because there's no way that the $3.5 million block of flats that sold in Mossman just before Christmas with a rental income, gross rental income of $139,000 on a $3.5 million block of flats, you can't tell me that that person bought that and they're an investor, right? So there's 3 things going on at the moment. You've got really low interest rates. I'll take the question just a sec. You've got really low interest rates, which are corrupting everyone's sense of risk. You've got a cohort of the population, a demographic cohort of the population, which is enormous, and that's the baby boomers. Now, after that, it's not a spike so much as a plateau, because my generation, which are the children of the baby boomers, we're just as many in number. So once it reaches that peak, it's flat for many, many years at the top. But what's happening is all the baby boomers are desperate for income, because you put $1 million in a term deposit now and you earn $29,000, right? The poverty line for a couple with 2 children in Australia is $39,000. So by definition, if you've got $1 million in the bank, you are impoverished. You never thought you'd hear someone say that, right? So you put $1 million in the bank, it used to be, you think about when you were a child and you thought, someone said to you, when you retire, you're going to have $1 million. You would have thought, well, I'm going to take it easy. I'm going to be rich beyond my wildest dreams. Or you wouldn't have believed them. Now when you've got $1 million, you're earning 29 grand in the bank. You know, that's less than the poverty line in Australia. So people are desperate to get more income because interest rates are low. So you've got interest rates are low, and then you've got this massive cohort of people desperate to earn more than $29,000. And so they're moving into other assets, and they've got this is the third thing, they've got a disproportionately large amount of cash because they all sold out at the bottom of the GFC and vowed never to go back into the stock market until it starts going up again, and it's been going up for a long time, and now they're getting in. So I think it's very, very dangerous to think that the basic principles of successful investing are different today than they were before. I don't think they are. I think this is a fad. It will pass. It could go for a very long time. It could be really, really popular hula hoop, but it is a hula hoop. And it'll be popular, and then it will stop being popular. And at that point, you'll be glad you didn't jump in.